Hello, clients and friends. This is Chad Roope, Chief Investment Officer here at Lineweaver Wealth Advisors. It's Thursday, April 17th, and it's been a couple weeks since we sent you a message last on April 3rd. So we want to give you a brief market update and rationale for trades we've placed in many of the investment strategies that we manage for you. The stock and bond markets have obviously been highly volatile with sharp down days and sharp up days with stocks. And interest rates have moved quite a bit higher at the same time. Just to briefly recap, President Trump announced a package of tariffs on April the 2nd that were far more aggressive and shocking than what markets expected. Those proposed tariffs were nothing like we've seen in a century. This caused intense pressure for stocks and sent interest rates higher, as I mentioned. On April the 9th, the Trump administration announced a 90-day pause on most tariffs, except those on China, which he ratcheted higher, much higher. The S&P 500 staged a massive relief rally on April 9th on this 90-day pause news and jumped nearly 10% that day alone, which is one of the largest one-day gains ever. Since then, we've largely been range-bound as we await more news. In the meantime, we've gotten some relatively solid economic data with retail sales and inflation data a little bit better than expected through March. Consumer sentiment, however, has really taken a large dip on this tariff news, which really highlights that a lot of the economic data before April 2nd is almost irrelevant. You know, as we discussed in our April 3rd video to you, we see two main paths moving forward, which really requires us watching closely how countries around the globe respond to Trump's tariffs. First, our base case remains the same today as it did April 3rd, that most countries will respond with negotiations. And again, this could be very positive and lead to lower overall tariffs compared to the last several decades and potentially fairer overall trade terms for everybody involved. We still think this is the most likely path and could be very positive for financial markets in the back half of the year after these negotiations have some time to take place. And, while we do not expect everything to be resolved during this first 90-day pause, we do expect some headway to be made in principle with many of these countries. Quite simply, we just think the proposed tariffs are far too great to be implemented as they just cause far too much damage to the economy and increase prices for you and me, far too much. It just doesn't seem the benefits would even come close to outweighing the negatives. So we just don't see how the administration could push them through as stated on April the 2nd. We also laid out a second path to you on April 3rd, and that one's one in which many countries retaliate with more tariffs rather than negotiating. Thankfully, this is not the path that's been taken by most so far, as this would create the greatest risk for the economy and financial markets. So far, only China has taken this path, but this week there's been some signs that China is willing to start negotiating rather than escalating and retaliating further. They did go back and forth with Trump, escalating, retaliating for a bit, but the last go around earlier this week, they signaled we're not going to raise tariffs anymore. It's irrelevant to raise them anymore, and they did signal some willingness to engage in talks and negotiations. And, we really hope those start soon. We do not think most countries will choose this path like China has, but, we're going to be watching closely. So to us, over the last couple weeks, what's really emerged is three buckets of tariffs. One, the first bucket is we get a group of countries that are essentially creating a free trade zone. How many and who these countries are will obviously be important. And the administration's indicated that there are potentially 75 or more countries that could join this group. We'll have to wait and see the specifics, but this could be a very positive development. Again, if you get a big portion of the global economy with lower tariffs and lower trade barriers than what we had before April 2nd. That could be a really good outcome. The second bucket is this 10% unilateral tariff for everything. We think that's likely to stick. I think Trump wants these in place to help raise some revenue, frankly, to offset some potential tax cuts that they'll probably be looking at later this year. So bucket two, 10% unilateral tariff, probably going to stick. That's our base case right now. And then third, of course, is just China. It's its own separate bucket. So those are the three buckets we're looking at right now. We think that probably a path for each of those, but bucket one, a group hopefully that comes together for a free trade zone could be super impactful. So have to wait and see, but over the last 2 weeks, that's what's emerged as the three most likely buckets for the tariffs in our mind. So, overall, we're sticking with our base case and think stocks could do quite well after we get some clarity on this group of countries that negotiate and more clarity on China. And, again, as we said 2 weeks ago, the likelihood of recession and bear market, those risks have undoubtedly risen. But we still don't think it's the most likely scenario as of now. We do think the negotiations will happen, and we think U.S. households and corporate balance sheets are strong enough to weather this shorter term period while negotiations take place. As of today, April 17th, the stock market, U.S. stock market, is measured by the S&P 500, is in correction territory, down about 14 or 15%. Since its highs around February the 18th. We think the stock market is going to continue to be bumpy, for the coming months during these trade negotiations. Again, 90-day pause, probably not over with in 90 days, probably going to be with us for a while, this bumpiness. But as we said before, since 1950, in years where you get 10 to 20% corrections, stocks are up usually about 12% on average since 1950 the following year. Okay, so that's going to help us regain a lot of the ground that's been given up if we get what's typical. And we here at Lineweaver, we don't want to pretend to know more than we do. We don't want to pretend to know when things turn positive. Rather, we try to lean into what's most likely to occur and not try to time the day-to-day movements. And as we saw on April 9th, news can change quick and really send stocks soaring. And we don't want to miss those days where the markets are up so much like they were on April 9th, up 10%. Missing those best days can really be detrimental to your portfolio. And we sent out a newsletter, I guess it was last week, that had a bunch of charts in it that shows if you miss some of those best days, how impactful it can be. So I'd encourage you to go back and look at that email from last week with some of those charts. I think they're super useful. As we said a couple weeks ago to you, we actively manage your investment strategies here at Lineweaver. Earlier this year, we trimmed some of the high-flying tech stocks. We just thought that they'd gotten ahead of themselves. And we've been holding some more defensive positions, gold in some strategies, and cash. And with this stock market sell-off, opportunities continue to emerge with high-quality stocks. A lot of these are trading at PE multiples that we think are very attractive right now. And we still think U.S. high-quality stocks are more attractive than international stocks for the most part. So over the last week or so, we've been executing a number of trades in most of the investment strategies that we manage for you. We've tried to tax loss harvest where we can in taxable accounts to try to help you with your 2025 taxes. And at the same time, we've added to our holdings in U.S. high-quality stocks, some of these that have the strongest name brands and some of the best balance sheets and some of the best management teams out there. And generally, they exhibit overall less sensitivity to the stock market moves. as we, expect this volatility to persist for the next few months, as I said. We did also increase our holdings in gold. Okay, it's a little uncomfortable because gold's at all-time highs. And look, we are definitely not gold bugs in any shape or form. We prefer companies that have an ability to grow cash flow and share that cash flow with us. Gold does not pay cash, any sort of cash flow. However, we think right now it's a little unique. The environment is uniquely favoring gold because of the way interest rates are behaving and the way the U.S. dollar is behaving, given all the uncertainty with the tariffs. So, we're not gold bugs, but we do think right now in this period of uncertainty, it's a pretty good hedge against both stocks and bonds. So we increased our holdings there, but we're likely not to keep that position for the long term. Okay, we're probably going to sell that once we get some more clarity and get back into those high quality stocks and bond positions that you typically see in your investment accounts here at Lineweaver. But we have placed those trades over the last week or so. I'm sure you got the trade confirmations. We wanted to give you a quick update here today on the markets, give you a quick update on the trades that we placed. And I also want to reiterate that if you have excess cash sitting on the sidelines right now, we think it's a good time to deposit some of that into your investment accounts and let us put it to work here in some of these attractive stocks that have come in and are trading at, frankly, quite attractive levels. So, we know all this policy change, all the market volatility, it's unnerving, no doubt about it. And that's what we're here for. We're here to help. We think now is the time for patience and to take advantage of the sell-off. Certainly no time to panic or make any major changes to your investment strategies. So, we'll be following all these issues closely, and we'll continue to be in touch with you as we learn more and update our investment strategies that we manage for you. So we really appreciate your confidence in our team. Thanks very much and have a great day.